Ladies and gentlemen, thank you very much for being here tonight. And the topic we're going to speak on is really a topic that needs a lot of focus. When I read the statistics some time ago, it was appalling to me. 70%, 90%, 78%. 70% of our wealth will be lost by the second generation. So I'm looking at my son, Paul. 90%, if the wealth gets by the second generation, it's unlikely that it's going to get by the third generation. Because 90% of inherited wealth is lost by the third generation. And today, the first generation is 78% not too sure that the next generation has the wherewithal to steward the inherited wealth. The converse of those figures would be only 30% of inherited wealth will be well stewarded in the second generation. Only 10% of inherited wealth, my grandchildren, will have a 90% chance of blowing it or 10% chance of stewarding it. Those statistics are ugly. So the question is, what are we going to do about it? The first solution to a problem is to define the problem. So we know that this is a problem. So how many of us are really consciously addressing that issue with our children and grandchildren? How many of us are really consciously addressing that issue? Because if we don't, what's going to happen? We become a statistic. So tonight, my value added here tonight is to try to engage the conversation in such a way that you leave with a methodology as to how to ameliorate those ugly statistics. When I first came into the business in 1977, I was 26 years old. I knew no one with money. So I had to go knocking on doors to sell mutual funds. And every time I got a prospect, and I would sit across the kitchen table from this family, in this family's home, I'd ask myself the question, what is the highest value added I can give to this family here tonight? And the answer kept coming back to me, singularly, make them wealthy. Make them wealthy. That's the highest value added an advisor can give to you, right? To arrange your affairs in such a way that the end result is wealth is created. That's the highest value added. So as a young engineer who became a financial advisor, I asked myself the question, is there a formula that if practiced consistently, there's only one outcome, wealth? So ladies and gentlemen, this was in 1977. Is there such a formula? No different from mixing two atoms of hydrogen with one atom of oxygen. What do you get consistently? Water. Is there such an equivalent formula to create wealth? Is there? Pardon me? Yes? What is it? Eh? What is it? You said yes. What is it? Why don't we try to Google it to see what would come up? Today, if you Google it, I assure you, nothing will come up. But in 1978, by studying, by observing, it came to me. And I'm going to prove it to you. So, firstly, if we don't know how wealth is created in the first place, we'll never be able to replicate it. So I've always been interested in the principles behind how wealth is created. And that's what we're going to talk about tonight. So any business person in the audience here tonight? You, sir? You're a business person? Yes? Okay, so what's your name, sir? Ken? Ken, do you have children? How many children do you have, Ken? A daughter? What's her name? Huh? Bree. Ken, suppose one day Bree came to you and said, Dad, you and Mom have done such a wonderful job, Dad. You have made me a confident person. You have given me experiences that my peers have not had. And because of that, Dad, I know my future is bright. Dad, I want to make sure that when I have children, I can give my children the same benefits and confidence and outlook that you and mom gave to me. Dad, how did you build your business? And the only reason you could have done it, Dad, is because you created wealth through your business. Right, Dad? Okay. So, Dad, tell me, what should I do to be able to replicate what you did? How did you create the wealth you did, Dad, through your business? What did you do, Dad? Ken, what did you do? Yes, you have a few successful businesses. What did you do? How to create the wealth? You use other people's money. But Dad, I know a lot of people who have used other people's money and they blew it. They went bankrupt. So using other people's money may be necessary but not sufficient to have created the wealth, Dad. What else did you do, Dad? No. He said go to Michael Eachin and ask him. You can see okay, you can see if we went a couple more iterations, it would be very difficult for Ken to say, these are the things I did in a formulaic way. It's very difficult. In other words, it's very difficult to teach behavior, right? But what if we could distill behavior into some principles? Then we could teach the principles, right? What if we could distill behavior into principles? Then we could teach the principles, and then we could replicate what it is we have done, right? So let's see if there are any principles behind how Ken created his wealth other than use other people's money, work hard, own a business, right? Let's see. Ken, would I be correct in saying, sir, that you created your wealth by owning a few high-quality businesses, sir? Before we go any further, is this a setup? This is not a setup, right? Okay, thank you. So would I be correct, Ken, in saying that you created your wealth by owning a few high-quality businesses? Say yes? Okay. Secondly, Ken, would I be correct in saying that you created your wealth by really understanding those few businesses? Would I be correct, sir? The audience can't hear you. Yes. Thirdly, would I be correct, Ken, in saying that you created your wealth by making sure that those few businesses that you own, few, are domiciled in strong long-term growth industries? Your business is not in a strong long-term industry? The industry that your business is it going to be out of business a few years from now? The industry will be there in one form or another. Okay, so it will be there, right? Fourthly, Ken, would I be correct in saying, sir, that you use other people's money prudently? They didn't hear you. Yes. That's four to four. And fifthly, Ken, would I be correct in saying you have persevered with these businesses and held them for the long run? 5 out of 5. So, Ken, all we have determined so far is I may have gotten lucky in terms of nailing those 5 points with you. So we can only refer to them as things, probably tenets. But let us see if we can transform them from being things or tenets into principles. Let's see. Ken, think of any wealthy person anywhere in the world. Have you thought of someone? Okay, let me see if I can determine the principles behind what that person did to have created wealth. Ken, I'm confident that that person you're thinking of created his or her wealth by, number one, owning a few high-quality businesses. Am I right, sir? They can't hear you. Yes. I'm confident the person you're thinking of, Ken, created his or her wealth by really understanding those few businesses. Am I right, sir? Yes. Just like you. Thirdly, I'm confident that that person you're thinking of owns businesses that are in a strong long-term growth industries. Am I right, sir? Just like you. Fourthly, I'm confident that that person you're thinking of created his or her wealth by using other people's money prudently. Am I right, sir? Absolutely. Just like you. And fifthly, Ken, I'm confident that that person you're thinking of has simply held those few businesses for the long run. Am I right, sir? So, just like you. So, what can we conclude? Can we draw any conclusions, ladies and gentlemen? Pardon me? Huh? Isn't that how wealth is created all through the world? Because he could have selected anybody anywhere in the world. I don't know who he was thinking about, yet still, the principle that he used to have created his wealth were the same as the arbitrary person that he was thinking of, right? So we now can conclude that wealth can be distilled down to a formula. And this is the formula. The 5 laws. Own a few high-quality businesses that you thoroughly understand. Make sure that these businesses are in strong long-term growth industries. Use other people's money prudently and hold these businesses for the long run. Now, every single successful person, consciously or unconsciously, they have made sure, or they're on side of the following 3 principles. They make decisions based on a sound intellectual framework. If you're a doctor, how do you make decisions? Aren't you taught frameworks, right? If you're a lawyer, aren't you rules-based? Am I right? So successful people make decisions based on a sound intellectual framework. Successful people also have the ability to control their emotions. And you can only control your emotions and have consistent behavior only if you have a framework that you really believe in that is part of your culture. So you cannot control your emotions unless you have a framework that is part of your DNA, your culture. And thirdly, successful people, they have access. And by the way, to be successful, you have to have all 3. If you have access, but you have no control of emotion and no framework, you won't be successful. If you have framework, control of emotion, but no access, impossible. In finance, it's no different. The framework we're going to talk about, which will give you control of emotions, and we're also going to talk about access. So those are the 3 things that we must have to realize success to be able to create success in finances, create wealth, and replicate it. Okay, so within the context of framework, Ken, the second column would really represent some of the characteristics of Ken and his business. The first characteristic is Ken is an owner-operator. Am I right, Ken? Ken is an owner-operator. So wealth is created in the real world by owner-operators. Ken is also, I'm sure, Ken's net worth would be heavily concentrated in his business. Am I right, Ken? Ken he also has a personal identification with that business. And if you were to ask his staff, they would say, Ken is an autocrat. Right? Ken is an autocrat. These are the characteristics not only of Ken's business, but of private businesses, owner-operators, heavily concentrated, autocrat. Ken would also be described as entrepreneurial, and his management is low turnover. Periodically, Ken has to make a profit, and he has to allocate that profit somehow, by another plant, by a company, etc. If his allocation is a prudent one, Ken's net worth increases. If it's not a prudent one, Ken will go bankrupt. So his risk-reward is perfectly symmetrical. Heads you win, tails you lose. Ken's time horizon is also long-term. If you were to ask Ken, what is your focus? Ken will say growth, long-term growth. So those are some of the characteristics of every single private business owner who have created wealth. So wealth is created by that second column under the private businesses. Now, the problem arises when we have a separation of ownership from the operations. Ken was an owner-operator. When you now separate ownership from the operations, which will happen when Ken has children and grandchildren, if you have 2 children, you're gonna they'll inherit your business at some point. So they are now owners. They probably may not want to get into the business. So they may say, to prevent us from fighting, let's hire professional management, right? So now you have separated ownership. They're still owners, but they're not in the business every day. So you have now separated ownership from management. And that usually happens typically in the second and third generation. But so therein lies the problem, ladies and gentlemen. Because whenever you separate ownership from management, you have to interpose a governance structure, which is no different from a public company. Public companies, the owners are different from the operators, right? So we know Ken's businesses will eventually, structurally, look like a public company because his children will now separate the owners, but they'll not necessarily be in the business running it. So what are the characteristics now that this business will have? Again, no different from a public company. And it's on the third column. We have separated ownership from the management, ownership from operations. Like a public company, you'll have ownership will be dispersed, broadly dispersed. The ownership could be eventually described as anonymous. Public companies, you don't know who the owners are. They're everybody. Management style is more democratic. If I were to say to Ken, would you, sir, as an owner-operator, appoint 6 other advisors, board members, none of whom has any skin in the game, and all of whom would have an equal vote to you? Would you do that, Ken? Would anybody do that? Okay. You would never do that. Hannah, would you do that? You never do that, right? Eh? No. But the highest form of corporate governance, has anyone ever taken a corporate governance course? The highest form, the best of class corporate governance is the majority of the board members should not be associated with the company. They should be unconnected. They should be independent members. What? But Ken just said, and you just said, you never do that as a private business owner. And wealth is created through private business ownership. So we now have separation of ownership from operations. You interpose governance. You have agency risk. You have people who are running the business who are not necessarily the owners. And therein lies the problem. So now, management style is democratic and bureaucratic. High turnover. Periodically, when these businesses make decisions, if it's a good decision, management gets a bonus. If it's a bad decision, management gets half the bonus. If it's a really dumb decision, management gets a golden parachute. Isn't that typical of public companies? Okay. The risk-reward ratio for decision-making is tantamount to flip a coin, heads you win, tails you don't lose. So it's asymmetrical. Management, public companies, few generations in advance of beyond us. Management, the time horizon is short-term because management is paid based on quarterly results. So their horizon is short-term. Ken's was long-term. And the focus of board members, advisors, would be risk and compliance. Am I right? Typical public company, focus of board members, risk and compliance, versus growth. So you can see that the characteristics that created wealth in the first place on the private business are totally different from the characteristics of public businesses, or when you separate ownership from management in subsequent generations, which is what happens. So if you have 2 different characteristics, what will you get? Will you get the same results? Pardon me? Impossible. If you have 2 different characteristics, you get 2 different results. So in the real world, wealth is created by making sure we abide by the characteristics of private businesses. So therefore, we have to make sure that we are consciously competent. So now, when Bree comes to Ken and says, Dad, what should I do? Ken is going to now say, Bree, we're going to have a 5-week course. Week number 1, what are we going to talk about? Week number 1, Bree, we're going to talk about what? What it means to own a few high-quality businesses, right? Week number 2, Bree, we're going to talk about what it means to really understand them. Week number 3, we're going to talk about what it means to be in a strong long-term growth industry. Week number 4, and we could spend many weeks on this one, how to use other people's money prudently. And week number 5, Bree, we're going to talk about how to persevere through to the long run. So now, ladies and gentlemen, is Bree having gone through that 5-week course, would she be a lot more equipped to replicate wealth than Bree, work hard, Bree, make sure you borrow prudently, Bree, right? Would she be more equipped? Yes or no? Yes. So, ladies and gentlemen, the first solution to those ugly statistics is to make sure that we understand and our children understand the principles behind how wealth is created in the first place, the 5 laws. Also, to make sure that our children, in fact us, firstly, and our children and grandchildren, understand there are some principal differences between private businesses and public businesses. And those are the differences. So therefore, Bree, whenever you make an investment decision, it's not that difficult. You have some tick boxes that you have to go through. So if someone comes to you and says, Bree, I have a wonderful investment for you. You say, okay, let me make sure, number 1, it fits into those 5 criteria. Is this proposal that is presenting to me, does it represent a strong, high-quality business? Do I understand it, or do I know someone who I trust who understands it? Are these businesses in strong long-term growth industries? Is this proposal that is being given to me one whereby the prudent use of other people's money is being adhered to? And is this proposal a business that I'd like to hold for the long run? So Bree can now have her checklist, right? So she will be able to make a better decision. Secondly, in addition to that, Bree will now say, okay, this proposal that is being shown to me, are the characteristics more like the characteristics of private businesses, or are the characteristics more like public businesses? So you see now Bree will be well equipped to make prudent decisions because she's now consciously competent. So at the bottom of the slide it says it's our responsibility to teach our children about framework. So we encapsulate all that I've said. Don't just invest, co-invest. Bree, don't just invest, co-invest. What is that, co-invest? Find people, Bree, that you trust, who have a track record, who are owners, operators, and who have characteristics similar to what I've just been through. On the other hand, you think about what I've just said, and if you superimpose what most of us do to try to create wealth, what do most of us do? We find a broker, right? And we say, okay, broker, I have some, here's my investable assets, and I'd like for you to invest. Invariably, what you end up with is a portfolio of securities that are 100% public, right? Isn't that what you get when you go to your typical advisor? Pardon me? Yes. So, you get a portfolio that is 100% public. Ladies and gentlemen, just ask yourself one simple question. Do you know of anyone in the world, name one person in the world, who has ever created their business, created wealth, by owning a portfolio that is 100% publicly traded securities? Do you know of one person? Pardon me? No. But that's what you get when you go to a typical advisor. That's because, again, and we accept it. We accept it. Simply because we don't have principles. We are not being guided by a framework. So we therefore end up being arbitrary. So what I'm here suggesting is, ladies and gentlemen, that we operate with a paradigm, and by the way, we are just not only, I'm not just referring to us here in Canada, but all over the world. Because all over the world, you go to, if you are interested in investing, you go to a securities advisor, and you end up with a portfolio that is 100% publicly traded securities. And as I just showed you from this slide, that's what you get on the right-hand side. Has no resemblance to how wealth is created. Wealth is created by owning businesses with the characteristics of private businesses. So therefore, whenever we're selecting public businesses, and yes, we should have some public businesses, we should make sure that the public businesses we own have the characteristics of private businesses. We find those businesses that are public, that have those characteristics. So what would some examples be? Loblaw, George Weston in Canada, Berkshire Hathaway, right? Those are businesses with characteristics similar to private businesses. Okay, so don't just invest, co-invest. Under the heading framework, I'm still under the heading framework. We cannot create wealth if we are offside of the mathematics of creating wealth. There's a mathematical formula that dictates how wealth is created. And the formula is the future value formula. FV equals PV times 1 plus R after tax, which is rate of return, to the nth power. Now, what that formula is telling us, if you invest $100,000 at 4% for 40 years, you'll end up with $480,000. If you invest at 8%, you'll end up with $2.172 million. If you invest at 12%, you end up with $9 million. Therefore, Bree, make sure whatever you do, you just don't park your net worth in the bank, because that's equivalent to it's not even 4%. Whatever you do, Bree, right? So you can see, because most of us aren't really being clinical, we just end up being arbitrary, and we end up not creating the wealth that is within our potential. So, this is a jumbled slide, but let me just explain this slide. Eventually, Ken is going to want to retire. So Ken is going to say, I've been working this business for 40 years. I want to sell it. So what's the process Ken will go through? Ken will now call in a Canadian business valuator to get a valuation on his business. So the valuator will come and sit with Ken and say, okay, Ken, tell me about the qualitative aspects of your business. So Ken would go through that process. Please, Ken, may I have the last 5 years audited financial statements? Okay, thank you. Ken, I'll come back to you in the next week with a valuation for your business. So the valuator goes out and searches the TSX to find a comparable, a business similar to Ken's that's traded on the TSX. A week later, he or she comes back and says, Ken, I've found it. I have a valuation for you. If your business was traded on a TSX, it would be liquid. It would be traded at 10 times earnings. But Ken, your business is not liquid, it's private. So I have to apply an illiquidity discount to your business, the valuation of your business. And that discount ranges from 25 to 40%. So Ken is going to say, what? My business is similar to that comparable. No difference in risk profile. Yet still, you're saying, Mr. Valuator, Ms. Valuator, that my business is worth 60% off? Yes, that's how businesses are valued. Am I right? Pardon me? So, what did we just hear? For no additional risk, let's flip it around now from the perspective of an investor. An investor who wants to invest has two choices in this case. They can go and buy $1 of earnings, Ken's business type of earnings, on the TSX, publicly traded, it's liquid, and he or she will pay $10. Right? 10 times earnings. The business was traded at 10 times earnings. So if you pay $10 for $1 of earnings, what's your earnings yield? 10%. right? Now, what if I could buy from Ken $1 of the same earnings? I'll be paying how much? $6. So what's my earnings yield now? Pardon me? $1 worth of earnings, I'm paying $6. It's 16.7%. Am I right? Same risk profile. The only difference is one is liquid versus the other. Right? So let us look at the results at the bottom of the page. If you take $100,000 and invested it at 10% for 40 years, you'll end up with $4.5 million. Same 100,000 at 16.7%, you'll end up with $47 million. Isn't that amazing? Pardon me? Isn't that crazy? So there is, ladies and gentlemen, a price we pay for liquidity. There's a price we pay, and the price is the difference between 47,000 and 47 million and 4.5 million. That's the price we pay for liquidity. Is it worth it? Pardon me? It's not worth it, obviously. That's why wealth is not created. More wealth is not created, because we get hung up on liquidity. So one of the first conversations we should be having with our advisor is, what percentage of my portfolio should be liquid versus illiquid? Isn't that so? Because I want to make sure I fill my illiquid component before I go to the liquid component. I want to make sure I fill my 16.7%ers before I accept 10. Shouldn't we be doing that? Pardon me, ladies and gentlemen? Is that being done today? Is that conversation being had today? No. So, ladies and gentlemen, you can see that there are a lot of accepted norms that don't make any sense if you're thinking, if your objective is to create wealth. I just gave you another one, a slide. This slide is very important. Okay? So Ken is going to say, breathe, honey. You have to make sure that you don't fall into the trap, the liquidity trap, because it's very costly. So, in summary, I can summarize all that I've said so far. The statistics are as ugly as they are because of two factors, the numerator effect and the denominator effect. So what are these effects? Well, most first-generation wealth creators act instinctively, which is difficult to teach, as I just proved with Ken. So it's difficult for them to really articulate the principles behind what they've done to create to their children and grandchildren. And if you can't articulate the principles behind your own behavior, you'll not be able to replicate it. Subsequent generations thus lack either one or all of the following: framework. You can see, unless you have a conscious plan to educate yourself and your children in terms of framework, you can see all the mistakes that we will make and have made, and they'll occur naturally. So, as such, it is natural for wealth to shrink. The numerator becomes smaller. So the second generation, remember I said 70%, there's a 70% chance of losing it because they don't have a solid intellectual framework by which they are making decisions. Hence, the wealth will shrink. That's the numerator effect. Control. So let's now talk about control of emotions. Mr. Buffett, when he was asked about investing, he said, investing is simple, not easy. Not easy. Why? Because it's very difficult to control your emotions, especially when times are awful or when times are really good. When times are really good, I am good. When times are really terrible, you feel paralyzed. So you're apt to make emotional decisions at those two extremes. Investing is simple, but not easy. He also said to invest successfully over the long term doesn't require stratospheric IQ. Thank God for that. Unusual business insight or any particular inside information. What's needed is a sound intellectual framework for making decisions, and secondly, the ability to keep our emotions from corroding our framework. Okay? So we just went through framework. And now we have to make sure we stick to our framework if we want to control our emotions, a la Mr. Buffett. But as I pointed out earlier, unless you are consciously competent as to what framework is, you're definitely going to be off the mark. Rahm Emanuel, he was an advisor to President Obama. During the middle of the crisis, he said, "You never let a serious crisis go to waste." And what I mean by that, it's an opportunity to do things you think you couldn't do before. Mr. Buffett, be fearful when others are greedy, and greedy when others are fearful. That's not very implicit, but that's how we have to be. That's all. All of this is within the genre of controlling one's emotions. Now, this chart is a very interesting chart. This chart represents the trajectory of Berkshire Hathaway over the years. Berkshire Hathaway, so about a year ago, 6 months ago, this client of mine called me and said, "Mike, have you seen the price of Berkshire Hathaway?" I said, "Yes, doctor." And Mike, do you remember when we bought it? I said, "Yes, doctor. We bought Berkshire Hathaway stock in 1990, and you paid $5,000 for it, $5,500 per share. And I had to fight with you to have gotten you to buy Berkshire Hathaway shares at $5,500 in 1990. Because at the time, President Bush Sr. had just bombed Iraq, and everything was, the stock market was down. So we had to fight with your doctor for you to have bought the shares. And by the way, if my memory serves me correctly, sir, you had bought 16 shares then. You paid $88,000 for those 16 shares in 1990. And if my math is right, sir, today at $225,000, those shares are now worth 4 million Canadian dollars. Am I right? He said yes. So 88,000 is now worth $4 million. But all through the years, I had to fight with this doctor because we had different crises, as you can see, and every time there was a crisis, he would call me. And I would say, "Doctor, why did you buy Berkshire Hathaway?" "Well, I can't remember. I can't think." "We bought it, sir, because it's, number one, it's a high-quality business. Number two, it's in strong long-term growth industries. Number three, number four, number five." "Oh, yes, I remember." That is what calmed the doctor down. So now the next crisis came. He called me again, and I had to fight with him again. I said, "Why did you buy Berkshire Hathaway?" "Number one, is it still a high-quality business?" "Yes." "Is it still in a strong long-term growth industry?" "Yes." "Do we still understand it? Is Mr. Buffett still competent?" Etc., etc. All along. So it's very easy, ladies and gentlemen, to whenever times are awful, to react emotionally. It's very easy when times are great to react emotionally. And the only way to have steadfastness in our behavior is to have principles, which I start off with. So, subsequent generations thus lack either one or all of the following. In this case, control of emotions. If we do not consciously behave in such a way, and at the same time teach them by our own leadership how to control emotions. So as such, it has natural as gravity for the wealth to shrink because of lack of control. The numerator again becomes smaller. Access. Access to what? Access to the right people, access to the right institutions, access to the right products, access to competitive financing. If you don't have access, your numerator, your wealth will shrink. So, subsequent generations thus lack, again, framework, control emotions, and access. As such, it's natural for the wealth to shrink. The numerator becomes smaller. So, the denominator effect now. It starts with the founder, Ken, first generation. Ken has 1 child, he'll have 2 children, right? So, the wealth will now be split. One wealth will now be split between 2 children. But the 2 children will take on a spouse each. So there'll be 4 decision makers. So you can see it doesn't take long for them to start fighting. And in so doing, they're going to say, "Look, for a peaceful life, let us bring in professional management, or worse yet, sell the business. Isn't that so? Bring in professional management, what do you get? Pardon me? Do you remember? 40% discount. What do you get? You bring in professional management, separate ownership from operations, right? And when you separate ownership from operations, you have to interpose a governance structure. So what do you now get? Remember that third column, right? Okay. So if then the third generation, you can see second generation will each have 2 children, so there are now 4 families, 8 decision makers. So by the fourth generation, there could be 8 families and 16 decision makers. Definitely like a public company. So you can see the denominator is expanding while the numerator is shrinking. So if you have a shrinking numerator and an expanding denominator, what's going to happen overall? Pardon me? The intergenerational destruction of wealth, 70, 90%. That's the reason why those statistics are as they are. So in summary, the numerator effect, the owner-operator model, is replaced by owners being separated from operators. A governance structure with agency risk embedded is introduced, and wealth growth is no longer the driver. The denominator effect, as we saw, the number of children in subsequent generation to split the wealth. Hence, the statistics are as they are. Ladies and gentlemen, is it clear? So therefore, do we now know what we have to do? Okay. So the question is, what is the optimal portfolio? What is the optimal portfolio? The standard approach, well, all of us, we have similar needs. Whether we are Warren Buffett or we are just we are an average person. We have similar needs. Our needs are to preserve capital when we invest, to have some liquidity, to have some income when we need it, to have growth, and to minimize taxes. Those are the common needs between everybody. Now, here's a standard approach. The standard approach, which is at the bottom row, you go to your typical advisor, what do you end up with? You end up with a portfolio of public fixed income securities, public equity securities, and cash. That's what you end up with. Now, again, if you were to ask any wealthy person, or let's bring it even closer to home, CPP, what are your needs? Onto your teachers, what are your needs? The wealthiest person in Canada, what are your needs? My needs are exactly the middle row. So how do you, CPP, onto your teachers, wealthy individuals, what does your portfolio look like? They'll say to you, in addition to public fixed income, in addition to public equities and cash, we have private equity, we have direct ownership of businesses, we have venture capital, we have real estate, we have infrastructure, and we have resources. Isn't that how CPP's investment profile is? Pardon me? So if the needs are the same, ladies and gentlemen, why should the portfolio profiles not be the same? Why? Pardon me? If the needs are the same, why should the portfolio profiles not be the same? But they are not. So we have a dysfunctionality here. So the question is, where can we in this room go and get a portfolio that resembles the top row? Where? Anybody knows? Where? Pardon me? Ladies and gentlemen, on a serious note, that's the reason why I started Mandeville. That's the reason why I started Mandeville. Because everything I have achieved in my life is a function of the fact that I started off with clients. And I recognize that there's a dysfunctionality in how clients are advised. So I could have said, well, that's the system. And continued on. But no, everything I've achieved in my life is a function of the fact that I have clients. In fact, I'm looking at a client, Ms. Ruth Ward, right in front of me. And Ruth has been with me for how long, Ruth? 25 years, right? And everything I've achieved in my life is the fact that I have clients. Ruth Ward being an example. So, There's a dysfunctionality in how advice is given. And worse yet, there's a dysfunctionality in what we expect because we don't know better. But all we have to do is look to role models, CPP, Ontario teachers. So why is Mandeville eminently qualified to deliver on this promise? Why is Mandeville eminently promised? Because, well, you could say, well, there are other public asset managers. Yes, there are. But there are less asset managers in Canada who can say, in addition to being public equities managers, we also manage private equities. And there are even less who can say, and our clients would include the government of Canada, the government of the United States, the European Investment Bank, the German Development Fund, DEG, the World Bank. And there are even less who can say, and we also, in addition to managing public equities, managing private equities with a roster of eminent clients, we also own businesses directly in telecommunications, in real estate, in bank financial services, banking, etc. And there are even less who can say, and we have also interfaced with clients around the kitchen table. There are very few entities in the world who can make those claims. Mandeville can. So, given the fact that I've identified a dysfunctionality in how advice is given and how what clients are expecting, because they just don't know better, because the system is such, the paradigm is such that we get the bottom row. What Mandeville does is saying, okay, we have created what we have done because of framework, control emotions, and access. So we're going to give our clients access so that they too can have an opportunity to make sure that they ameliorate those dirty statistics. That's the reason why Mandeville was founded. Let's do some case studies. We talk about access. And you should be asking yourself this question. Why would I want to do business with Mandeville? Let's talk about access. In 2006, two entrepreneurs, one from Halifax, his name is Mr. John Risley, Clearwater Seafoods, and another from Burlington, myself. We started a company by the name of Columbus Communications in 2006. John has his bank of clients. Portland has its bank of clients. And the first asset we bought was that undersea fiber optic cable you see depicted in that picture. So that asset, we paid $80 million for it. That asset is an undersea fiber cable that starts in Boca Raton and hops to every single Central American country. Up the Eastern Caribbean passes Trinidad, Barbados, Dominican Republic, Cuba, back to Miami. It's a ring. We paid $80 million for it. And that undersea fiber optic network enables all of those countries to communicate with the world. So it's like owning the 407 highway. So if you go to Mexico, there's a 25% chance that you're paying us, Columbus, a toll. If you go to Colombia, 100% chance. Panama, 40% chance that you're paying us a toll. So we bought this. But at the time, it's like buying the highway. This was in 2006, before the traffic really came. Because at the time in 2006, you didn't have all the downloading that is now occurring, the Yahoo, the Google, etc., etc. So we bought that business, and that was our wholesale platform. We paid $80 million today. That business, that wholesale business, as of last year, was giving us cash flow of $150 million per year. Then overlaid on top of that, we thought, wouldn't it be great if we could roll the clock back 40 years and invest in Rogers? Wouldn't that be great? But unfortunately, we can't do that. So how about if we found an area of the world where that Rogers movie is just about to start, and we be the ones who flick the switch? How about? Which we did. So we overlaid on top of that business, our retail business, which sells, which the brand name is Flow, which sells internet, telephony, and cable. That business, since between 2006 and 2014, and of 2000, gave us another 150 million. So both businesses together gave us cash flow. We started the business in 2006. As of last year, it was spinning off cash flow of $270 million. Our clients were also our partners. So our clients had access to that business. In 2013, the wealthiest, the most successful telecom investor in the world, his name is John Malone from Liberty Media, which is the largest cable company in the world, sought us out and bought 20% of our baby, Columbus. Last year, we sold Columbus to Cable and Wireless for, how much was it, Rob? $3 billion. We got the check in March, and our clients also participated. They had access. Just on this past Tuesday, it was announced again that Liberty Global is buying Cable and Wireless for $5.3 billion. And our clients participated all along. They had access. So that's a case study in terms of access, and that was not available anywhere else but Mandeville. And so why did we start Columbus? Because it goes back to having a framework. Ladies and gentlemen, as an investor, there are 3 preconditions. And again, Ken, Bree, sweetheart, there are 3 preconditions that you always have to look for. This is part under the heading framework. Before you get excited about creating wealth in any opportunity. Number 1, there has to be a difference between perception and reality, Bree. Because only when there's a difference between perception and reality can you have the knowledge arbitrage. And you can't create any wealth unless you have knowledge arbitrage. Am I right? Secondly, Bree, there must be inefficiencies, because only when there are inefficiencies can you create wealth. If everything is already efficient, no wealth to be created. And thirdly, Bree, there must be a lack of equity capital flowing into the region, the sector, or the industry, or the business. Because only when there's a lack of equity capital can you create wealth. Conversely, Bree, if the opposite must be true, if there is no difference between perception and reality, you can't create any wealth. If everybody knows the same, you can't create any wealth, right? So ladies and gentlemen, let me ask you a question. Has anyone ever been into a brokerage office? Anybody? Has anyone ever stepped foot into a brokerage office? Invariably, what you see, whether it's in Canada, the United States, Australia, Germany, Jamaica, doesn't matter. What you see the brokers sitting in front of the screen. Which screen is it? What's the name of the company? Bloomberg, right? So every broker in the world is being piped information from the same source. So how can there be any difference in knowledge if they all have the same information? Is that possible? So the first precondition was what? There must be a difference in perception and reality to have the knowledge arbitrage. If knowledge is efficient, if they're all getting it the same, how is it possible to create any wealth? Impossible. Okay. So Columbus, we started Columbus because it met all 3 preconditions. Second case study in terms of access. In 2013, the European Investment Bank gave us a call in Burlington, and the name of the gentleman, his name is Cyril Arnaud. So Cyril called, I took the call, and the European Investment Bank is our client. And if you Googled EIB, European Investment Bank, the first thing that comes up is the largest public financial institution in the world. So they called and said, Cyril called and said, Mike, in 2008, the sovereign states of Germany, Norway, and the EIB, we started this fund of funds. We call it GREF fund. Tonight when you go home, you Google GREF, you'll go straight into EIB's website. So we started this fund in 2008. And the fund is a fund of funds, so it invests in private equity funds. And we capitalize it with 112 million euros. And we are now going to invest, we have invested in, and we will be investing in 10 private equity funds. And each private equity fund, they're looking for businesses in the global energy efficiency and renewable energy space throughout the world. And their mandate is to find businesses that will give them a 20% hurdle rate, yield, return per year. That's their mandate. So I said, okay, what does that, why did you call me? He said, what we'd now like to do is to double the size of that fund from 112 million euro to 224 million euro. And so I said, what are the features of this fund to our investors? So I said, okay, let us refer to the initial investors, Germany, Norway, and EIB, as tranche A. The subsequent investors, us, as tranche B. The tranche B investors, although they are coming in today, will get the same price as the tranche A investors got in 2008. And they are embedded capital gains. Ladies and gentlemen, firstly, when was the last time you have had an opportunity to co-invest? Remember that term, co-invest? With sovereign states of Germany, Norway, and the EIB. When? Pardon me? Never. That doesn't happen. No access. So in addition to getting stale dated price, which is legal, in addition to that, he said, well, investors in the tranche B investors will get first loss protection. What's that? Cyril, what is that? That was my reaction. Well, first loss protection is for us coming in with our 112 million euro second today, Germany, Norway, and the EIB will have to lose their entire investment, their 112, before we lose a dime. Ladies and gentlemen, when was the last time you've been invited to come into an investment with first loss protection? When? It's tantamount to investing in a mutual fund, and every unit holder who bought before you are going to lose all their money before you lose a penny. When was the last time you've heard of anything like that? I was blown away. So now, I said, okay, Cyril, how about when it's time for capital to return to us? He said, here is the hierarchy. Number one, although we're coming in 2015, we'll get 100% of our capital out before Germany, Norway, and EIB get a penny of theirs. Last in, first out. And once we've gotten 100% of our principal, we'll get an annualized yield of 4% before Germany, Norway, and the EIB get a penny of their principal back. So we have first loss protection, preservation of capital. We have priority of return of our principal plus a 4% annualized yield before tranche A gets a penny. Once we have gotten our 4%, only then will Germany, Norway, and the EIB get their capital back. And once Germany, Norway, and the EIB get their capital back, we get a further 6%. So the score is how much? 10% return, 0 to the tranche A. And thereafter, we'll split whatever residual gains are emanating from the private equity funds equally. So if there's another 10%, 5% to tranche A, 5% to tranche B. So the result will be 15% to us, 5% to Germany, Norway, and the EIB. It's asymmetrical in our favor. Ladies and gentlemen, have you ever heard of anything like that? Pardon me? Never, nor had I. But we're fortunate that we have access, and we give access to our clients. So access is important. So that fund was voted by the Private Capital Markets Association of Canada as Fund of the Year, Investment Fund of the Year 2014, because of those characteristics. Why? They are our clients. And they selected four agents throughout the world, one in Asia, one in Europe, one in South America, and we are the North American agent. We are their clients. They know us. Yes, all the agents. All the tranche B investors got the same deal. Having access, okay, Portland Private Income Fund. Here is a fund which, again, in 2015 was the Private Capital Market Association Fund of the Year. The framework is based on private debt. It's knowledge-based lending. Control emotions, disconnected from public markets, so there's no mark-to-market. Access, co-invest alongside institutional pension plans and family offices. We're investing in mortgages. The annualized returns that we have seen since inception, 9.3%, and there's no fluctuation, fairly no fluctuation in the unit value. Contribute to the growth of the Canadian economy through financing real estate development and mid-market companies. This again has the imprimatur of being Fund of the Year by the Private Capital Markets Association. Access to private equity fund. That is, if I go back to that portfolio, private equity is one of the asset classes, right? Where can you get access? Nowhere. The private equity fund that we manage a private equity fund, and I've already mentioned who the investors they are. Over the last, in the shaded column, in the shaded box, it has delivered an internal rate of return of 17% to our investors, and the cash return is 2.5 times, approaching 3 times cash, 3 times as much as they have invested. So, we have to, in terms of preparing the next generation, we have to make sure we educate our children carefully to ensure alignment of framework, control of emotions, and we have to make sure that our children have access. And it has to be all three. If we have two but not the other, it doesn't work. That's why the statistics are as they are. It's unlikely to have success because if you aren't consciously, by design, educating in those 3 areas, you will be arbitrary. And very few people are actually consciously doing that. Lead by example. Lead by example. The highest form of leadership is to lead by example. Our decision-making process needs to ensure alignment of our decision-making as first generation framework so that our children that's a part of their culture. Control emotions and access. So we have to lead by example. So we have to examine what it is we are doing. And are we on side of all that we have spoken to over the last hour? And most important is to make sure you align with the right advisors. Advisors who have a framework that is rational and defensible. And advisors who have control of emotions because their framework is part of their DNA, their culture. And advisors who have access. Ladies and gentlemen, unfortunately, this availability is not wholesale. I don't know of anywhere else in the world that this is available. I don't know of any. If you know of any other firm that is taking this approach, please tell me. And by the way, if you know of a better way to ameliorate those statistics, please tell me. This is the best I know, and I'm sharing it with you. But if you don't know of a better way, what should you do? With that, ladies and gentlemen, you have been most attentive. Thank you very much.